A very good morning, friends. So I hope you're all doing well. So I think today becomes a very interesting journey, and we will be starting with a very interesting and I would say an important topic, which is pertaining to financial reporting in CFI, and that is financial instruments. So I'm Kapileshwar Bala, and I would be taking this very interesting topic and make you a walkthrough on the journey. And of course, I would, say that yes, you will get a very good hang on this particular topic. But the only, I think, request and the demand I would say is that you need to make a cumulative revision of what we cover in this particular topic. Now, when I say a cumulative revision, that means after the first class, the expectations are that you're going to revise this topic. Then, after the second class, you should take a quick recap on the first one and the second one, because this is a pretty long topic and of course involves a lot of inputs as well. So I think the only dedication and the inputs demanded is that you should keep making a revision. So by the time we, let's say, reach the seventh class, the expectation is that you're going to make the revision of all the seven classes put together. I know, maybe asking a little more, but trust me, since it is an important and a little larger topic, we need to put in that desired kind of efforts. And I'm pretty confident and sure that you're going to do that as well. So we've got almost like 10 sessions which are going to be devoted on financial instruments. It's of course one of my favorite topics as well. And I would, try my best in order to give you this topic and give you a very good understanding and a hold on this topic. We're going to do a plethora of questions also. We're going to conceptually understand the topic. Nowhere we're going to learn this topic. We're just going to concentrate on the logics and get a finer understanding of this topic. So I think let's begin with the journey. So I am now going to first of all introduce you to the topic on financial instruments. Whenever we hear of any topic, the very first question what comes to the mind is what is financial instruments? But I think before I answer the very first question, that what is a financial instrument, I would like to first of all give you an insight that there are a total of three standards devoted to the issue. So I think before we come on to the technical definition of what is a financial instrument, let's first of all understand the framework within which the financial instrument accounting is contained. So I think in the first instance, what I'm going to give you is the three standards. So let me know, friends, if the board is clearly visible to you, so that I know the font size is working good. So just send me a message on the chat box if you can see the visibility is clear, the font size is working good to you. So that will be a good inputs coming from you. Okay, so as I said, when I look at the concept of financial instruments, I would say that there are a total of three standards which deals with the agenda. So we can divide the journey of financial instruments in terms of, I would say, three different standards. One is called Ind AS 32. One is Ind AS 109. And the other one is Ind AS 107. So we've got three standards which are devoted to the concept of financial instruments: Ind AS 32, Ind AS 109, and Ind AS 107, and they all deal with financial instruments itself. But they deal with a different aspect of financial instruments. Like if you look at Ind AS 32, it talks about presentation aspect. Now let's not get worried at this stage that what do we mean by a presentation aspect. We'll understand that logically. It's just a nomenclature which is just coming to your mind at this stage. That Ind AS 32 talks about the presentation of financial instruments. Ind AS 109 talks about recognition and measurement. It talks about the concept of recognition as well as the concept of measurement. So I would say this contains a little more core accounting, I would say. It contains more of the core accounting, and that tells you how the accounting of the financial instruments is done. And then Index 107 talks about the disclosures. It talks about the disclosures. So all these three standards are pertaining to the same agenda, and that is financial instruments. But each one of them tackles a different area of financial instruments. So as of now, we just need to keep in mind that 32 is talking about presentations, 109 is talking about recognition and measurement, and 107 is talking about disclosure. Now, in order to understand that this standard is talking of presentation, measurements, or disclosure, we need to get a little more idea that what is a financial instrument. So I think before we discuss a bit on these three standards, I think I'm just going to first give you a basic exposure in terms of understanding that what is a financial instrument, basically looking at a definition of a financial instrument. So basically looking at that what is a financial instrument, looking at the definition. And let me also tell you that all the definitions pertaining to financial instruments are given in Index 32. So any definition you want to refer to, you can just go to Index 32. It contains the definition. Now, without making it very complicated, now hear me very carefully. When you look at the definition of financial instrument, it says that financial instrument is a contract. I think the very first and the most important keyword in the definition is that financial instrument is a contract. And we all know this very well, that contract is always between a minimum of two parties. So the next question is that when I say that financial instrument is a contract, I would like to know that which are the two parties. I would like to know that, sorry, I would like to know that which are the two parties which are involved in this contract. And we can technically call these two parties, if I were to define that which are the two parties, we can say one of the party is called issuer. And the other party is what we call holder. So I think just to give you the nomenclature, that the two parties are supposed to be the issuer and the holder. Now let's take an example to understand who is an issuer and who is supposed to be a holder. I'm fond of putting some questions also, so I would love to get some inputs from you as I put the questions to you. Now, first of all, let's take a very basic example. Let's say, for example, I said that A Limited issues, let's say, shares. If I say A Limited issues shares, is it going to present it on the asset side of the balance sheet, or is he going to present it on the liability side of the balance sheet? I think it's a bit obvious question, but let's get some answers on your side. So when I'm looking at that a company A Limited issued shares, so is he going to present it on the liability side, or is he going to present it on the asset side of the balance sheet? I guess you can easily decide. A company is issuing an ordinary share. It is issuing an equity share. So where is it going to present it in the balance sheet of the company? And that's rightly said. It is going to be presented on the liability side of the balance sheet. That means A Limited is going to present it, mind the words, A Limited is going to present it in the balance sheet of the company, but he is going to take a call. Because when you look at a balance sheet of the company, he needs to take a call. Is it equity or is it liability? If you just go back and remember the format of the balance sheet, then we can say the balance sheet has got an asset side and the balance sheet has got an equity and a liability side. So which means when A Limited is going to issue these shares, he needs to decide, is it own funds, that is called equity, or is it loan funds, that is called liability? So in this particular case, he needs to decide the presentation. He needs to decide the presentation in the balance sheet, that is he going to present it as own funds equity, or is he going to present it as a loan fund that is a liability? And let me also tell you that in my example, A Limited is supposed to be the issuer. So we can say A Limited in my example is supposed to be the issuer. So the issuer needs to decide the presentation in the balance sheet. Mind the words. A Limited needs to decide the presentation in the balance sheet. Is it to be presented? I'm not saying accounting. Is it to be presented as equity, own funds, or liability? Now you might say, sir, equity shares is going to be presented as equity. Let's not get into that. Let's not take a decision at this stage. We're just saying that A is facing the issue. That is he going to present it as equity or is he going to present it as a liability? Now let's take the extended example. Now let's consider in this particular case, B Limited is the other company. What it does, it invests. Let us say A Limited is the company which invests in these particular shares. So when you say that B Limited is a company which makes an investment in these shares, undoubtedly, but I think I'll still ask you, is he going to present it on the asset side or the liability side? If B as a company makes an investment in the shares issued by A, undoubtedly I think you'll agree that this would be presented on the asset side of the balance sheet. So B is going to present it on the asset side of the balance sheet. But as far as assets are concerned, assets are assets. Assets are assets. Unlike a liability side where you've got two subheads, equity and liability, on the asset is just asset. I'm not talking of current and non-current assets, etc. But when you say it is asset side, an asset is an asset. So if you look at the balance sheet presentation, the concern is more on the liability side. The person issuing the instrument needs to take a call, is it equity or is it liability? But the person investing will undoubtedly say that it is an asset. So coming back to the picture, let me ask you a little obvious question now. So if you look at the name of the standard in AS 32, it says presentation. Would you like to make a guess? As per my discussion, the presentation where? Based on my discussion, let me ask you a question. When I'm looking at a presentation, I'm looking at presentation where? I think in my entire discussion, I have very equivocally said that word. So would you like to tell me presentation where? And that's right, it's a presentation in the balance sheet. Superb. So when I'm looking at Index 32, it is telling me how are you going to present it in the balance sheet of the company. And let me tell you one thing. I am more concerned, please hear this carefully, I am more concerned with the presentation for the issuer. Because whether the issuer shares its equity, the holder, the other party holder, B is the holder, he would say it's an asset. The B says it's a liability, holder would still say it's an asset. So when we're going to focus in terms of Index 32, our focus is going to be mainly on the issuer perspective. So when I'm going to focus on the balance sheet presentation, my focus is mainly going to be from the point of view of the issuer. We are basically going to concentrate on the issuer presentation. So Index 32 tells you that when a company issues an instrument, equity share, debentures, preference shares, loans, etc., in those particular cases, is the instrument to be presented as an own funds called equity or is it to be presented as a loan funds called liability? But the holder invariably will end up saying that it is supposed to be an asset. Did you get the basic connect so far, friends? I'm going to go slow, but I want the foundations, the basic learning gets developed in a very good manner. I guess so far so good. You're able to connect the basic dots on what Index 32 addresses on. That's wonderful indeed. Let me take it a little further and let me go further. Now, if you look at the standard, to just introduce certain technical terms to you. If you go further in the definition, just let me introduce a little more technical terms. The standard says that when a company issues an instrument, that is issuer, and the other company invests in that instrument, that is holder, they say the issuer will end up saying It's equity. So we're going to call that equity as equity instrument. So when the issuer says that it is equity, we're going to call this as equity instrument. Now let's not get worried on what is equity instrument. Just remember, equity instrument is like own funds. Or he will end up saying it's a liability, but we're going to use the technical word financial liability. So he will basically take a call. Is it to be presented as equity, called an equity instrument? Or is he going to present it as a liability? So we're going to use the word financial liability. But as far as the holder is concerned, irrespective, it says it is equity or he says it's financial liability, he's going to call it as an asset, and we're going to technically call this as a financial asset. Instead of just calling it as an asset, we're going to call this as a financial asset. Wow. Which means what is working at the back of the mind now? Let me just consolidate the few dots. So when a company issues an instrument, so we can say he's going to decide is it equity, it's called equity instrument. He's going to decide its liability, we're going to call it as a financial liability. And as far as the holder is concerned, he will always land up saying it's a financial asset for me. The issuer says it's equity instrument, the holder says financial asset. The issuer says financial liability, the holder says it's a financial asset. So I think what we need to learn is what is an equity instrument? What is a financial asset? What is a financial liability? I think if you're able to understand these three terms, we will be able to understand the concept of financial instruments. So what we're going to do, we are going to first of all concentrate on understanding what is an equity instrument, what is a financial liability. And by the time we've understood financial liability and equity instrument, trust me, we will indirectly, automatically understand a financial asset. So I think we're not going to concentrate on the financial asset for the time being, but we will focus on the issuer perspective, understanding what is an equity instrument, what is a financial liability, what are the parameters which an issuer needs to apply in order to take a decision that it is supposed to be equity instrument or it is a financial liability. But before that, let's come back. We're still on the introduction of the standard. Now coming to the next agenda, and that is Ind AS 109, which talks about recognition and measurement. Now, I think I would like to remind you that you must have done a couple of asset-related standards. Like, for example, when you studied Ind AS 16, property, plant, equipment. Like, for example, when you did Ind AS 38, intangible assets. Or like, for example, when you did Ind AS 40, that is investment property, you would recall that there was always a recognition criteria. Because when you say that a PPE is going to be recognized in the balance sheet or not, you always decided a recognition criteria. And that recognition criteria was, in terms of PPE, is the future economic benefits probable? The recognition criteria was, can the cost be reliably measured? So every standard lands up giving you what is called a recognition criteria. Will I be able to recognize the financial liability, the equity instrument, the financial asset in the balance sheet? So Ind AS 109 tells you the parameters of recognition. Can an issuer recognize it as a liability or equity? Can the holder recognize this as a financial asset? But more so, our focus is going to be more on the measurement aspect, which is the core accounting. So I would say if somebody would ask me that, okay, what does 109 tell you? I would say it gives you the accounting to begin with. It gives me the accounting for financial assets. It gives me the accounting of financial liability. So in this standard, you are going to learn the accounting of financial assets. You're going to learn the accounting of financial liabilities, and of course, much more. It's not that a journey is going to end only in terms of understanding the accounting of financial assets and liability. There is a lot of other agendas also which are discussed in 109. I don't want to give you the terms at this stage to scare you. We'll get that exposure as we go ahead with the standard. And finally, when you're looking in terms of the disclosures, disclosures are always given in the notes to accounts. Because unless you give appropriate disclosures to the reader, he will not be able to understand the essence of your accounting. So now you can get some picture at the back of the mind. That when you're looking at financial instruments, the standard series created a total of 3 standards in order to understand financial instruments. So one of the agenda was deciding the presentation. One of the agenda was deciding the presentation in the balance sheet, typically from the issuer perspective. Because holder will always land up saying it's a financial asset. It is the issuer who has to take a call and decide, okay, this is equity. That's called equity instrument. This is liability, called financial liability. The other person will say financial asset always. And then comes the core accounting of financial assets and liabilities in 109 and the appropriate disclosures in 107. I hope, friends, now you get a basic framework in your mind that what financial instruments talks about. This was an introduction to the concept of financial instruments. So we are now going to go one by one. We'll start a journey in Index 32 and then move on to 109. 107, of course, you'll not see that coming in the exams much because of disclosures. But I think as we understand 32 and 109, automatically you get a lot of facets. In terms of Index 109, that is the disclosures as well. So far, so good. Any questions coming to your mind so far? Or we are good to go ahead? Okay, so I'm getting some good answers coming in from the other chat as well. So I think so far so good. So no questions so far. That's great. So I'm again requesting everybody that, what we do today may not sound very technical, but I would still insist and request that, you should revise what we do. Because what you're going to do cover in these 3 hours, it'll barely take you not more than around 30 minutes to 45 minutes to consolidate all the learnings for the first class. But of course, as we're going to move ahead, the need will also be that I'll keep making a cumulative inputs to you because we'll tend to forget at times, okay, what did we do? But don't worry, I'll keep helping you to bind the topic very well. And we'll keep doing good number of illustrations as well. So let's, I think, begin the journey. So let me give the focus point. Now we're starting with Index 32, and I've already given you the basic essence that when you say a financial instrument, it's a contract. And there are 2 parties in the contract, issuer as well as the holder. And my focus right now is on the issuer. But considering that it is a complicated standard, I am going to give you some good examples to understand the logics as well. So what I'm going to do now, I'm going to share some examples with you. Pure, simple examples where you just need to apply common sense. I'm going to give you a transaction where you just need to apply a common sense. And based on that common sense, we will reach a conclusion that when the issuer issues an instrument, is it equity or is it a financial liability? Now, let me tell you one thing, friends, at this stage, so that you are connected with my thoughts. I am going to give you a 3-step model. I'm going to give you a 3-step model to decide when is it equity and when is it liability. I'm going to give you a 3-step model, version 1. Once you've understood the version 1, I'll go to the version number 2. Once you've understood the version number 2, I'm going to give you a version number 3. Oh my God. Now you must be thinking this man sounds dangerous to us. Am I sounding dangerous to you? Say no. Because what I'm going to do, I'm going to build your concept on a step-by-step basis. I am going to give you a 3-step model, version 1, So to get a grip on that, once you get the grip, I'm going to break that and take you to the version number 2. Once you get that, I'm going to give you the final version, that is version 3. So the 3-step model comes in 3 versions. Am I scaring you at the moment? No. So we're going to learn this on a step-by-step basis. Trust me, by the end of the 3rd version, you will feel very confident indeed. Let's begin. So at the first instance, before we come to the 3-step model, I'm going to give you some questions. You apply common sense. You apply your previous concepts with a common sense and try to give me inputs that what do you feel would be the answer. Let's begin some common transaction. I'm taking individuals just for the basic understanding. Let's say there is Mr. A and let's say there is Mr. B. I am considering simply 2 individuals just to understand the transaction. Now I'm going to give you transaction 1. Mr. A approaches Mr. B. Mr. A approaches Mr. B and takes a loan. Mr. A approaches Mr. B and takes a loan. Tell me, is it equity or is it liability for A? A is taken a loan from B. So is that equity or is that a liability for A? And I quickly get the answers that it is supposed to be a liability. Okay, let me also give you some more inputs. Let's say A issues debentures. Let's say A issues debentures, then is it going to be equity or a liability for A? If A lands up issuing debentures, I'm getting good answers that it becomes a liability. Now let me tell you one thing, friends, very clear, which is a very important essence of the standard. The name of the instrument can never ever be a deciding factor. Please get this very clear, because this is one thing which you need to unlearn in life. I also remember, when I learned the standard for the first time, I understood, and one thing which came to my mind, I always telling people that, you cannot decide by the name of the instrument that it is equity or liability. The general belief is that if a company issues equity shares, one would hear this word equity shares and say, oh, it's equity. When a company raises a loan, you'll say loan is a liability. When you say a company issued debentures, you'll say it's a liability. The name is totally irrelevant. The name is totally irrelevant. The name of the instrument can never ever be a deciding factor. So one thing which you need to keep in mind very, very cautiously clear, that when I use any word like loan, the name is irrelevant in nature. Please do not get guided. Please do not get guided with the fact that I'm using the word shares, I'm using the word loan. No. This is one of the important misconceptions which people have got. This standard is going to teach me the art of deciding what is equity and what is liability, not on the basis of nomenclature. Tomorrow, in the future, if anybody says company issued shares, is it equity or liability? Tell him, you need to give me more facts of the case. I cannot be deciding on the name of the instrument that you say it's shares. That does not mean it's equity. If somebody says a company issued a debentures, tell him this is incomplete data. You cannot decide on the basis of the name of the instrument that it is equity or liability. If you tell me debentures is just a name for me. So that means you want to tell us that debentures can land up becoming equity, or yes? So you want to tell us that debentures can become a case of a liability, or yes? So it is the substance of the transaction which will be a deciding factor. It is not the nomenclature which is the deciding factor. This is a very important input I'm giving you. So I am overemphasizing the facts. I'm overemphasizing the impact because today when you go to sleep, I'm sure you're going to see me in your dreams, though it's too early to see me in your dreams today. But you're going to definitely hear a voice coming in and telling you that name is irrelevant. Never ever decide that equity shares are equity. Never ever decide loans, debentures, are liability. Did you get my point? The name of the instrument is completely irrelevant in nature. So this is something which you need to keep in very crucially into your minds. The name of the instrument is irrelevant. Okay, now let's begin the journey. Now I'm coming back to the point. Let's say A took a loan from B, let's say for 10 lakh rupees. Now please hear the facts very carefully because you need to give me some data. So let's say A took a loan from B. A tells B, I will pay you interest every year. I'll pay you interest every year. And then I will pay your principal money back. I'm going to give you your principal money back, let's say at the end of 5th year. So A tells B that I will give you interest every year, and at the end of 5th year, I'll repay the principal money back. And he says, I'll give you the interest and I'll give you the principal all in terms of cash. Will Mr. B accept the deal? My question is very simple. Will Mr. B accept the deal? A took the money from B and tells him that I'm going to pay you cash for the interest every year. I'm going to pay you the principal, and that also going to be paid in cash at the end of the 5th year. Do you think Mr. B will accept the deal and say it's fine? I know it's a pretty simple question, but you might land up thinking too much at this stage. But just apply basic common sense and logic and tell me, do you think Mr. B will accept the deal? You've got to say a yes or a no. So I think people are getting apprehensive of the fact that do we say a yes or a no on this? Okay, I think maybe I'm getting some messages on the chat on a personal box. If you can message on everyone, I think that would be great because otherwise I'll have to, go through your chats on an individual level. I think, yes, I got a yes on that. That's right. So in this particular case, the answer is, of course, we will say, yes, I accept the deal. I don't have a problem. You pay me the interest every year in cash, and you pay me the principal at the end of 5 years in cash. That's fine. B will accept the deal. This is one. Let's give you another option. Let's give you another option as well. A tells Mr. B that instead of giving you cash, I will give you shares in my company. Now, please hear this carefully. A tells B that instead of giving you cash, I'll give you shares in my company. So he says, so let's do one thing. Now, hear the deal very carefully. He says, sir, I need to pay you a principal of 10 lakhs, and let's assume that I also have to pay you some X rupees of interest. He says, I will add up the interest for the next 5 years compounded. I'll add up the interest for 5 years compounded. I'll give you interest on interest. I don't pay you anything in between. But I'll take the principal and add the interest on a compounded basis. He says, sir, my share today is prevailing in the market at 500. This is the price of the share in the market as of today. So let me decide the number of shares to be given to you today itself. Though I will give you the shares after 5 years, mind you, I tell B, though I'll give you this pre-decided number of shares after 5 years, but I will decide the number of shares to be given to you today itself. But I'll give you these shares at the end of 5 years. Will Mr. B accept the deal? Do you think Mr. B would accept the deal in this particular case, considering that A tells B that I'll give you the principal with interest compounded, and let me decide the number of shares today, considering the price of my share today is, let's say, 500. So let me pre-decide and give you the shares and I'll give you these shares at the end of 5 years. So do you think in this particular case, B would agree to the deal? So I guess I get the answer, no, sir. The reason is that the price will vary. That's wonderful indeed. So let me put it like this. I think you can maybe vouch me on that. Can I say the possibility is it depends? I'll not say that B will refuse the deal. I'll not say that B will accept the deal. Let me put it like this. Can I say it all depends upon the perception of B? If B's got the perception that the price of the shares of A will increase, mind the words. If B has got the perception that the price of the shares will increase, he'll say, yes, let me go ahead. And if B feels that the price of A shares will go down, he'll say, no, I don't want it. So can I say it depends upon the perception of Mr. B regarding the share price of A. If he feels that the price will go up, he'll say, okay, I'm ready. But if he feels that the price will go down, he'll say, no, I don't want these shares. So can I say he may accept the deal, he may not accept the deal. It all depends upon the perception, how the share price movement will take place. Agreed? I think you'll agree on that, that in this particular case, Mr. B's perception towards the share price of A is the deciding factor. Okay, that's wonderful indeed. Now let's give you a third option. As well. Right now we're discussing something generic. We're discussing something which is basic common sense in life. That somebody tells you that I'm going to pay your money back in cash. Somebody tells you that instead of giving you cash, why don't you take the shares in my company? But he tells you that I'm going to give you a pre-decided, some number of shares which is pre-decided to be delivered at a later date. Then you decide maybe yes, maybe not. Now, let's give you another deal. Now Mr. A tells Mr. B, I'll give you shares. But he tells Mr. B, it's not fair. He tells Mr. B, it's not fair that I pre-decide the number of shares. Let's decide the number of shares after 5 years. So why should I divide the money to be paid to you by the price prevailing today? He says, let me do one thing. Let me add the interest on a compounded basis, but let me divide it by the market price per share, which is going to prevail after 5 years. So indirectly, he's telling Mr. B, if the price goes down, mind it, he's indirectly telling Mr. B that if the price goes down, I give you more shares. If the price goes up, I give you less shares. But indirectly, you get as many shares, so you get your money back. So he doesn't pre-decide the number of shares. He said that the number of shares can vary in the future. They can vary in the future because if the price goes down, I give you more shares. And if the price goes up, I give you less shares. Now tell me, will Mr. B accept the deal? Now tell me, in this particular case, will Mr. B accept the deal if A is not pre-deciding the number, but he says, I'll give you the shares to be decided at a future date. Let's wait for the price after 5 years and then let's decide. And I get a yes on that. That's right. So I think in this particular case, Mr. B would, of course, say a yes. Let me just consolidate the dots. So I think we've all equivocally agreed on 3 agendas. I'm just going to, give you the summary of the 3 agendas, and then we can proceed further. If Mr. A tells B that I'll pay the interest and the principal in cash, B will say, okay. If Mr. A tells Mr. B that I will give you a pre-decided fixed number of shares which will not change, Mr. B may say a yes, Mr. B may say a no. And number 3, when Mr. A tells B, I will not pre-decide the shares, we will decide it at a later date. He says the number can vary depending upon the price of the shares 5 years later. Mr. B will accept. So Mr. B accepts the deal when it is in cash. Mr. B accepts the deal when it is in variable number of shares, but Mr. B may accept or may not accept it is 6 shares. Agreed. Agreed with my 3 agendas in this case. Wonderful indeed. That's great. That's great. So I think all my friends are in perfect agreement to me. So I think many of you must be thinking, so ultimately, what are you up to? Don't worry, I'll tell you what am I up to. Now, I'm going to first of all tell you something. Please hear this carefully. I'm not giving you the logic right now. I'm not giving you the logic right now. But I'll give you the logic in the next 5-10 minutes. So don't get worried on the logic. First, just understand one thing. The standard says that if your mode of payment, the standard says if your mode of payment is cash, it is a financial liability. It's not the name, but it is the mode of payment which decide what is equity and what is financial liability. So the standard says if the mode of payment is cash, it's a financial liability. The standard says that if the mode of payment is variable shares, it is a financial liability. So remember, it is the way you pay. The mode of payment is the deciding factor. So if your mode of payment is cash, it's financial liability. If the mode of payment is variable number of shares, it's a financial liability. But if the mode of payment is supposed to be a fixed number of shares pre-decided, it is called an equity instrument. Now you'll say, sir, no, this doesn't work. You are making me cram. No, I'm going to give you logic. But for the time being, I've just put into your mind that how you discharge your obligation is the deciding factor. So when I say in this particular case, the mode of payment is cash, financial liability. The mode of payment is variable shares, financial liability. The mode of payment is fixed shares, equity. So but why? Let's explain the why to you now. Let me explain the why to you, but I think you at least got the dots connected. That name is irrelevant. So what is the deciding factor? Mode of payment. So what is the key essence to be remembered now? That when you decide an instrument is equity or liability, you're not going to decide with the name. You're going to decide with what? Mode of payment. Your mode of payment is the deciding factor, that you pay cash, FL, you pay variable shares, FL, you pay fixed shares, equity. Sir, you now need to give us a logic. I'll give you logic. You want logic? You have the right to say no, then I won't give you. You've got the right to say yes, then I'm going to give you logic as well. So you want me to give you logics? Undoubtedly, yes, sir. We definitely need logics. So, okay, let's start working on the logics now, friends. I'm working towards my version number one. In order to understand when an instrument is equity and when is it a financial liability. So let's now understand the logic. So let's give you now the logic. And for the purpose of understanding the logic, I'm going to take you back to the school days, where we understood something very important, but we never realized the importance of that very basic concept what we learned. So I'm just going to revive you back and take you back to the school days to, understand that, yes, that's what you did. I remember when we were in school, we were taught a very basic fundamental that a company works on two kinds of funds. One is called an own funds and one is called a loan funds. So in school, you would all remember that you were told that a business runs on two kinds of funds. One is called own funds and one is called a loan funds. And we also realized later that own funds is what you technically called equity. And loan funds is what you technically call liability. So the company runs on two kinds of funds, own funds and loan funds. And then we were given some very basic understanding of what is an own funds and what is a loan funds. And I'll remind you what we were taught in school in terms of deciding that is it own funds or is it supposed to be a loan funds. And we were given a very important agenda in terms of deciding own funds and loan funds. We were given an understanding that there is a return in the form of interest and dividends, and there is a principal repayment. So every time you decide that it's an own fund or a loan funds, we consider what is the status of return. When I say the status of return, we're looking at the interest and the dividends. And we start looking at the concept of principal money. What is the status of the principal repayment? Now, let me put some questions to you, basic understanding. Let's go back to the school. Let's forget about the financial instruments right now. And let me ask you, if a company used to take a loan, is the liability to pay the interest mandatory? Even if a company does not earn a profits, is the payment of interest mandatory or is it discretionary? When a company takes a loan, in that particular case, is the obligation to pay the interest, is it going to be mandatory or is it going to be discretionary in nature? Even if the company does not earn a profits, and that's right, it is going to be undoubtedly mandatory in nature. So as far as a loan is concerned, the payment of interest is something which is mandatory. A company is liable to pay interest. A company is liable to pay interest even if it is not earning profits in the current year. And what about the concept of principal? Am I also liable to pay the principal money back? Yes. If the loan has got a tenure of 5 years, you need to pay this money at the end of 5 years. So which means that the repayment of principal is also mandatory in nature. It's an unavoidable obligation. It's an unavoidable obligation. The payment of interest is mandatory. The payment of the principal is mandatory. You've got unavoidable obligations to pay. So in this case, that's the status. And that's what we say, it's a liability. But let's come back to equity. Let's come back to own funds. Is the company liable to pay dividends on equity shares? And is it liable? Or is it completely discretionary? Even if I earn profits, am I obliged to pay dividends or it's a pure discretion that I may not pay dividends? I think you'll rightly vouch me that payments of dividends is completely discretionary in nature. It is completely discretionary in nature. The company may not pay dividends even if it earns a profits during the year. And what about the principal money? Can I say the principal money is paid on liquidation? And can I say that money is paid only after paying all the liabilities if there is anything left? So can I say this money is paid only on liquidation? The company does not pay this money during its lifetime. It's paid only on a liquidation. Well, we all know this. Now, I want to look at another aspect of this understanding. We all know this very well, that interests are mandatory, the principal on the loan is mandatory, the dividends are discretionary, and the principal is paid on liquidation only. I want you to apply your thoughts and tell me, first of all, one thing, that if you start looking at all this input from a risk perspective, please apply your thoughts. If you start looking at all this from a risk perspective, tell me, if a company issues equity, please think carefully. If a company issues equity, whose risk is that? Issuer or the holder? You're telling the holder, dividend is my discretion. You're telling the holder that principal is paid on liquidation. So who runs the risk in terms of equity funds? The issuer or the holder? And that's rightly said. So can I say the risk in this particular case is by the holder? The risk is completely on the holder because the company is not liable to pay anything. The risk is being run by the holder himself. And who runs a risk in terms of liability? Well, as an issuer, I tell him, don't worry, I pay you interest even if I don't earn profits. I pay a principal money back after n number of years. So is the issuer running a risk to arrange the money, or is the holder running a risk? And I think that's rightly said. It is the issuer who is supposed to be running a risk. I think you have all understood now this very well. Now let me just connect the dots. If you get this, you're about to get the logic as well. So now let's start looking at the other way around, and let's put it like this. If the risk is on the holder, it is supposed to be equity. And if the risk is on the issuer, it is supposed to be a liability. I'm just trying to connect the dots. If the risk is on the issuer, it's a liability. If the risk is on the holder, it's equity. Get this straight. The moment the risk is on the holder, it becomes equity. The moment the risk is on the issuer, it becomes a liability. Now let's come back. Let's come back and put the questions to you on the risk perspective out here. So let's put the questions to you on the risk perspective out here. So let me ask you a simple question. When Mr. A tells B, I will give you cash, who runs the risk, A or B? When Mr. A tells B that I am going to give you cash, who is running a risk in that case? Is it A or B? A tells B, I have an unavoidable obligation to pay you this money back in cash. And that's right. Can I say in this case, the risk is on the issuer? If you were to see, the risk is on the issuer, and if the risk is on the issuer, what do you call it? Financial liability. Did you get the correct? As an issuer, I say, I'm going to give you cash, I'm running a risk. And if I'm running a risk, it is a financial liability for me. Let's come back to the issue. When the issuer says, I will give you as many shares so that you get your money back. If the price of my share goes down, I give you more shares. If the price of the share goes up, I give you less shares. Who is running the risk? Is it the issuer or is it the holder? Can I say again, the risk is on the part of the issuer because he's going to give you as many shares so that he discharges his obligation to the fullest extent. But now let's put the third question to you. When the issuer says, I'll give you a fixed number of shares, when the issuer says, I'm going to give you a fixed number of shares, who is taking the risk, A or B? You tell Mr. B, I'll give you a fixed number of shares. If the price goes up, you're lucky. If the price goes down, you're bad luck. So in this particular case, I think you got this correct. Can I say in this case, the risk is taken by the holder, and if the risk is taken by the holder, undoubtedly you can understand it is equity. Wow. Are you getting a little more confidence and feeling, yes, I'm getting some logics in life? Say yes. So are you getting some confidence in terms of, deciding things? We'll connect the dots also, no worry. I get that bold language, yes. That means you've understood it very well indeed. Superb. Very, very confident. I love that. I am getting a lot of messages on the individual level. I think maybe you just need to change your chat to, message to everyone. Then I think I will be able to see your messages better. So, once you're messaging, just see that, you put on a message to everyone, then I think I'll get my message accordingly. Because I think many of your messages are on the setting which says, sending it to me on a personal level. So I think then the chat box will work on that. I'll get your messages on the front. Unable to select. Oh, okay. I think many people are saying we're unable to select, but then I think few of you have got that selection. Okay, we will probably check that. So let's, I think, friends, connect the dots in terms of the learnings we have developed so far. I am now coming to the points once again. I've given you the logics, but I'm just connecting the dots. Just say the sentences, we'll document, no worry. So we can say that if as an issuer, I pay cash, I take the risk, and therefore it's financial liability for me. As an issuer, instead of cash, I take my mode of payment shares. I am still taking a risk to give variable number of shares, and therefore it's a financial liability. As an issuer, if I pre-decide the number of shares to be given, then I am not taking risk and passing the risk to the holder. Then it becomes an equity. So giving a cash and giving a variable number of shares is taking a risk on the issuer. It's a financial liability. And when you say that the fixed number of shares are given, it's like passing the risk to the holder. It becomes an equity. So what is most important essence we have learned is it the mode of payment which is the deciding factor, or is it the name? It's the mode of payment. How you are going to discharge your obligation is the deciding factor. The name of the instrument is irrelevant in nature. I guess we are now ready in terms of making some notes on the version number 1. And we can do some questions also at this stage. We can do some questions also at this stage right away. But I think let's first make some documented notes to you, because as you're going to study, you'll need some documented notes as well, not these kind of scattered notes. So once I'm explaining the concept, I'll be explaining it. Then I'll also document the notes to you so that everything gets penned down with you and you can revise it very well. So let's begin the journey. And of course, these notes are going to be shared on the LMS as well, on the ICAI portal, so you will be able to access them as well. So let's come to a 3-step model. Let's come to a 3-step model and let's make some notes. And this is what I said is the version number 1. It is the version number 1. And as I've already said, I'm going to give you 3 versions, one by one, slowly and steadily. We'll keep putting some inputs in between. So I'm giving you a 3-step model, version number 1. And this model is deciding what? This model is to decide. This model is to decide from the issuer point of view. This is to decide from the issuer point of view. So we are using this model to decide from the issuer point of view that is it a financial liability or is it an equity instrument. So the focus is on Index 32 to make a decision that is it a financial liability or is it an equity instrument from the issuer perspective. Now, let me just add a few things which I didn't say earlier, but I'm going to put that in my step number 1. If we look at the definition of a financial liability, it says that there is a contractual obligation. If you look at the definition of financial liability, it very clearly says that there is a contractual obligation. So your very first focus in every case study, in every question is going to see that does the issuer have a contractual obligation? So you need to identify, does the issuer have a contractual obligation? Mind you, the obligation has to be contractual. The obligation has to be by way of a contract. So your very first step would be to ask yourself a question that does the issuer, the very first question is, does the issuer, let me underline issuer, does the issuer have a contractual obligation? So does the issuer have a contractual obligation? And let me just underline very clearly the word contractual obligation. So you will put across the very first question, does the issuer have a contractual obligation? Let me ask you a very simple question just to get the dots connected. Let's say my company is liable to pay income tax to the government. It's an obligation. Yes. But is it a contractual obligation? Do I have a contract with the government of India? Do I have a contract with the income tax department that I pay them the tax? Is it obligation by contract or is it obligation by statute? So what do you say? When I'm looking at my obligation to pay taxes to the government, is that an obligation which is by contract or is it by law, that is by statute? And I think you will rightly agree that when I'm looking in terms of the obligation to pay taxes to the government, I have got no contractual obligation to pay. So what is most important is when you're working on the very first step, be very ensured that the obligation has to be by way of a contract. So when I say it's a contractual obligation, we are saying it's not by statute. It's not by a statute. It is not supposed to be by statute. It is obligation by a contract. So the first thing you need to see is that the issuer has got an obligation by way of a contract. So the answer could be a yes or a no. So the answer could be a yes or a no. So if the answer is no, the standard is not applicable. The standard is not applicable because if the answer comes no, I am outside the purview. Because if you remember, financial instrument we said is a contract. So when you say it is a contract, there has to be a contractual obligation for one, and there has to be a contractual right for the another. So if it is not there, the standard does not apply. If you say a yes, then we go to the step number 2. If you say yes, then we go to the step number 2. Let's go to the step number 2 now. Now, in terms of the step number 2, which is the most crucial step, and that is considering that what is the mode of payment. So as I said, it is not the name of the instrument which is important. It is the mode of payment which is the deciding factor. So we will see that what is the mode of payment. So when you say it is the mode of payment, when you say the mode of payment may be cash, or the mode of payment is shares. Generally, I'm saying the mode of payment is generally cash or generally share. If there is any other mode, for example, hear this very carefully, if there is any other mode, say for example, goods and services, it is not a financial instrument. So let's say, for example, if you say that the mode of payment, if I put it across that the mode of payment is by way of, if I say the mode of payment is by way of, the mode of payment is by way of goods or services. If the mode of payment is by way of goods and services, then in this particular case, it is not a financial instrument. I think let's take some examples and you can answer this better so we get conceptual clarity of thoughts as well. Let me just go back and put some questions to you. My company sold a laptop to the customer, giving him a warranty card. My company sold a laptop to a customer, giving him a warranty card. Is that warranty card, does it trigger a contractual obligation? Yes or no? So when as a seller, I sold a laptop, and in this particular case, I gave a warranty card to the customer. So when I gave a warranty card to the customer, does it trigger a contractual obligation? And that's right, he said, yes, it is undoubtedly a contractual obligation in this particular case. So we can say, yes, it is supposed to be a contractual obligation in this case. I go to the step number 2 and put across a question. When you are going to discharge your warranty obligations, are you going to give cash? No. Are you going to give shares? No. Are you going to give them goods and services in return? Yes. So is this financial instrument standard going to be applicable? No. The standard is not going to be applicable. So let me make another statement to you. Let's say, for example, my customer gives me an advance for goods. Let's say my customer gives me an advance for the goods. Is that going to be a financial instrument? Do I have a contractual obligation? Yes. But is the contractual obligation going to be discharged by way of cash and shares? No. Am I going to discharge by way of giving in goods or by way of giving in services to the customer? Yes. Did you get my connects? Did you get the dots connected? That your mode of payment is also very crucial. It's not only that you've got a contractual obligation, feature one, but it is also the mode of payment, which is more or less an exhaustive list for the time being, that either you give shares or you give cash. If it is anything other than shares and cash, by way of goods and services, the standard does not apply. Now, we decided that if it is supposed to be cash, it is going to be a financial liability. If it is going to be shares, then I'll go to the step number 3 in this particular case and then decide. So let's, I think, go to the step number 3. And what we're going to do now in terms of step 3, you are going to see the number of shares. You are going to see the number of shares in this case. So when you say the mode of payment is shares, we'll say, okay, let's decide, is the number fixed, predetermined, or is it going to vary? So number of shares we need to see, is that pre-decided and fixed in number? If you say it is fixed in number, it becomes an equity instrument. It becomes an equity instrument. And if you say the number is going to vary, it's variable in number to be decided at a later date, then it is supposed to be a financial liability. Well, I think we're ready to do some questions now with you. I'm now ready in terms of doing some questions with you. But before we do questions, I want to get your comfort zone, friends, at this stage. Would you like to give me your scores on a score of 10 regarding your comfort zone on this? Give yourself a score on a score of 10. That what is your comfort zone? I get the first score 9. I get a score 10 by 10. That's lovely indeed. I'm just checking few more messages and I get another 10 out of 10. Wow. Another 10 out of 10. That's wonderful indeed. I'm feeling confident, looking at your answers as well. It also gives me a very good feeling indeed. Trust me, my gut feeling tells you that I'm going to do 1 or 2 questions with you, and I am 100% confident, not even 99. I'm 100% confident that you will decide it's a financial liability or equity. Absolutely correct. Let's go to the study material. So I'm carrying with me the study material, selected pages, unit number 1 and unit number 3. So right now I'm taking you to the questions which are there in unit number 3. I'm just going to take you to the questions which are there in unit 3. So let's have a look out here. I think let me just, crop this a bit so that you can get a better understanding, see it visually better. This is unit number 3, and in the unit number 3, we've got illustration number 13 and 14. Let me know, friends, if this is clearly visible to you. Just let me know if the visibility is good. Can I continue with this? You can see the question well, visibly well. Yes, I think I get the answer. Yes, it's visibly fine. Okay, wonderful indeed. Let's, I think, then take it further. I'm doing, first of all, the question number 13. We're just going to read the question number 13 very carefully. So please apply the 3-step model which I've given you. Go step by step, it'll go wrong. So what are you going to do? You're going to first of all decide that there is a contractual obligation for the issuer. Yes. Focus on the mode of payment. If it is cash, it's FL. If it shares, you go to the step number 3 to see the fixed and the variable content. Let's begin. It says CBA issues convertible debentures for a subscription of 100 crores. The debentures are convertible after 5 years into equity shares using a predetermined formula. It's not a predetermined number. Please don't mistake it with a predetermined number. It says it's a predetermined formula. Now we need to see this formula very carefully. In the numerator, they multiplied 100 crores into 1 plus 10% raised to power 5. It's like giving the principal with an interest compounded at the rate of 10%. If you notice the numerator carefully, it is like paying the principal amount with an interest of 10% compounded for the next 5 years. And we're dividing it by the fair value on the date of conversion. So you just need to take a decision that is it fixed number of shares or is it variable number of shares? Decide, friends, and tell me, is it equity or is it supposed to be a financial liability? So apply your inputs and decide that is it equity or is it a financial liability? I think I've started getting answers on that. And I get the answer financial liability. I get another answer, it's financial liability. We get another answer, it's a financial liability. And one of the person giving is saying it's equity. Okay, it cannot be equity, friends. It cannot be equity. Let's go step by step. I said I was confident 100% you're going to give me correct answer. Okay, let's work this. But I think majority of you got absolutely correct answer. Now let's go and apply a simple 3-step model in this case. Hurry can make curry. And you don't have to go hurry. You need to go cautiously and go step by step by step. Now it says CDA issues convertible debenture. Now my very first question is that CDA is the issuer. Does he have a contractual obligation? I would say yes, there is definitely a contractual obligation on the part of CDA. Then I go to the next input and say that, okay, what is the mode of payment? And we say that the mode of payment is supposed to be shares because we are going to give equity shares at the end of 5 years. And if you look at the formula, you are dividing by the fair value prevailing today, or are you dividing by the fair value which is going to prevail 5 years later? It's the fair value on the rate of conversion. It is the fair value after 5 years. So is the number pre-decided? No. Is the number variable? Yes. And I think if the number is variable in nature, you've decided that it is supposed to be a financial liability. Super. It's as simple as that. Because we can see, and on the contrary, let's say instead of writing fair value on the date of conversion, let's say I write down fair value on the date of issue, then what would it become? Equity. Because if I divide it by the fair value on the date of issue, in that particular case, it is a fixed number of shares, it becomes equity. What is the name of the instrument? Debenture. But what will it become? Equity. So is it the name which is important or is it the mode of payment? You know this very well now. It is the mode of payment which is more important in nature. Well, you can have a read on the solution as well. It says the contract is a financial liability, even though the entity can settle it by delivering its own equity instruments. I'm reading ahead, it says, entity is using its own equity share as a currency. It is not an equity instrument because the entity uses a variable number of its shares as a means to settle the contract. So I think I mentioned the same thing, except that it's arranged in a chronological order. Let's try once more. Let's try one more question. And this time, I don't see the possibility of anybody going wrong. Let's, I think, look at the illustration number 40. It says DF issues convertible debentures for a subscription of 100 crores. The debentures are convertible after 5 years into 15 crore equity shares of 10 each. You cannot give a wrong answer on this. This is like asking you, Basanti, tumhara naam kya hai? And if you land up saying Basanta, it's your problem. Because this question is very clear. It is telling you that I'm going to discharge my obligation by way of 15 crore shares, which is a pre-decided number. Let me still see what are the answers I'm getting on this. And that's right, we get the equity, and we get the equity. I think this time everybody is absolutely correct indeed. So I think I'm pretty happy that now I think everybody is given the correct answer indeed. It is supposed to be equity in nature. Super. So my confidence is correct. Then now we've decided very well. Let me still, I think, go one by one. I think if I go with the first step, is the contractual obligation? Yes. What is the mode of payment? It is shares. And I think if I go to the step number 3, it is fixed number of shares. When it is a fixed number of shares, it is undoubtedly equity instrument in nature. Wow. So I think we're settled with the version number 1. It's time now to introduce you to the version number 2. So trust me, we're going step by step. As we do these things, you'll feel that, this is easy. What's the need of revising things today? I've understood everything. But I will still insist, I will still request that you need to sit down and spend some time making revisions. You get a grip of the concept, because when you're learning for the first time, it has to be built on a very systematic manner. So please do not compromise on your revisions. And now we'll come back on the agenda, and I am now going to discuss with you the version number 2. So now we're going to discuss the version number 2. But before we discuss the version number 2, I think let me insert something very interesting in your mind. Now hear this very carefully, because what I'm about to tell you is something very interesting. And it is pretty logical. And it is pretty logical as well. But we just need to get the dots connected very well. So before the version 2, I am giving you a clarification. Before the version number 2, I am going to give you a clarification. This is a clarification to the 3-step model. So I'm going to give you a clarification which is on the 3-step model. And let's see what is the clarification. Is it possible that as far as the return is concerned, it is paid by cash? And let's say as far as the principal component is concerned, the principal component is paid by shares. That means I'll land up using 2 different modes of payment. What I'm coming to the point is I'll land up giving 2 modes of payment. Yes, it is possible. I tell the other party that I'm going to give you interest every year in cash. And I'm going to give you a principal money, which is going to be paid in terms of shares. So which means, I'm just now thinking, if you say the mode of payment is supposed to be cash, I would end up saying it's a financial liability. And let's say if the mode of payment is shares and you land up giving a fixed number of shares, it becomes an equity instrument. Oh my God. If one component becomes a liability and the other component becomes an equity, it is called a compound financial instrument. Sir, G beta, I gave you that if one component is equity, another component is liability, it is called a CFI, a compound financial instruments. So you need to run the 3-step model on both the components separately. You need to run the 3-step model on both the components separately. The moral of the story in terms of clarification is you're going to run the 3-step model on the principal component separately. You're going to run the 3-step model on the interest component separately, because you will end up deciding that one component is FL, another component is equity, then it is called CFI, compound financial instrument. So moral of the story, what is the clarification? The clarification is that you need to run the 3-step model. You need to run the 3-step model. So that is the clarification. You need to run the 3-step model for each component separately. For each component separately. This is the most important agenda. This is the most important agenda, that you need to run the 3-step model for each component on a separate basis. If your mode of payment for the return is different, the mode of payment for the principal is different, you cannot afford to apply the 3-step model on the entire instrument in entirety. in the previous two illustrations, 13 and 14, what you've seen, that the mode of payment for the principal and the interest put together was all in equity shares. So we were deciding and applying the three-step model in one go. But if you notice that the mode of payments are different, you must run the three-step model on a separate basis. And what is going to be the conclusion? What is going to be the conclusion in this case? The conclusion is if both the components are FL, if both the components are FL, the overall instrument is financial liability. If both the components are equity instruments, let's say both the components are equity instrument, it becomes an equity instrument. But one of the components is FL and the other component is an equity instrument. It is called a CFI. That's called compound. That's called a compound financial instrument in this case. I hope, friends, you got the connect in terms of a CFI. Which brings me to a very interesting input at this stage. As an issuer, when I issue an instrument, it can be equity 1. It can be liability 2. It can be a compound financial instrument, which is basically a blend of debt plus equity, a blend of liability plus equity. The issuer may land up saying that the instrument is a pure FL, it's a pure equity, or it is supposed to be a compound financial instrument. So please remember one important input I've given you. I'm not giving you anything too much technical so far. I've just given you, first of all, a three-step model to decide whether the instrument is equity or FL for the issuer perspective. Then I just give you a simple clarification for the version 1 that you're going to apply the version 1. You're going to apply the three-step model for each component, the return and the principal on a separate basis, because if both components are FL or both components are equity, whether one is FL equity, it becomes a CFI. Now we're ready to go to the version number 2. I hope you stand very clear on my thoughts. Okay, so I am now going to take you further and let's go further. Very clear indeed. That's great. Super. Now we're going to work on the version number 2 and let's go ahead. Let's work on the version number 2. So I'm now working on my three-step model. That's version number 2. I've created these steps and I always call them as, KV's three-step model because it's my creation. So I call them the name that's KV's three-step model. I'm writing three-step model, but I just love them calling them as KV's three-step model. So in terms of the three-step model, I am now giving you a version number 2. I'm giving you a version number 2 now. We're working with the second version, which overrides the version number 1. No change in step 1, no change in step 3. No change in step 1, no change in step 3. So in the version number 2, there is no change. There is no change in the step number 1 as well as the step number 3. The only thing which I'm changing is the step number 2. Now what am I changing in the step number 2? Please hear me carefully. In step number 2, earlier I said if the mode of payment is cash, it's a financial liability. I override it. Now onwards, you're not going to say that if the mode of payment is cash, you can't reach a conclusion it is a financial liability. No. The standard has got the understanding that if you say the mode of payment is cash, there should be unavoidable obligation to pay cash. Mind the words carefully. When I say that the mode of payment is cash, you need to prove it to me there is unavoidable obligation to pay cash. It's like this, that I will pay in cash. Let's put it like this now. I say if I pay in cash. I tell the person, if I pay in cash. There is not unavoidable obligation. Now, if I say I have to pay, and I'll pay cash. So you need to see that if the mode of payment is cash, there should be unavoidable obligation to pay cash. So how will we assess that the obligation to pay cash is unavoidable in nature? No worry, I'll tell you. So I'm making the changes in terms of the step number 2, that if your mode of payment is cash. So I'm making the changes that if the mode of payment is in cash, what you need to do in this particular case, you need to prove that there is an unavoidable, there should be an unavoidable obligation. There should be an unavoidable obligation to pay cash. Okay, so I am getting, says, yes, you named three-step model. It's already registered in my mind. Very good. Wonderful indeed. I love it. Now, I'm going to give you some words, and with the help of which we will decide that is there an unavoidable obligation to pay cash or not. Now, there are certain terminologies which we are going to use. There are certain terminologies which we are going to use. Now, what's these terminologies carefully? When it comes to a payment of return, that is in terms of interest or in terms of dividends, we're going to see some technical words. When we're going to see the concept of a principal repayment, when we're going to consider the concept of a principal repayment, we're going to see some terms. We're going to see some terms. So when it says that the interest or dividend is mandatory, when it says it is mandatory, that indicates it is a financial liability. Because when you say the interest is mandatory, there is an unavoidable obligation to pay the interest and the dividends. But when you say that the return is discretionary, when you say that the return is discretionary, that means there is an avoidable obligation to pay. It's going to be equity instrument. So when you will apply the three-step model to the return component, when you apply the three-step model to the return component, you will put across a question, is the payment of interest dividend mandatory? Then it is financial liability. But if you say that the payment is going to be discretionary, then it becomes equity instrument. So you're going to see the words mandatory, discretionary, and that will decide whether it is FL or is it equity. Look for the words. Look for the words mandatory and discretionary. Similarly, in terms of principle, you'll see the word redeemable. If it is redeemable, you've got an unavoidable obligation to pay money. It becomes a financial liability. But if you're going to see the word, it is irredeemable in nature, then in that particular case, it becomes an equity instrument. You know what? You need to watch out the words now. When you look at the question, you need to watch out the words. If I say the mode of payment is cash, your mind should be running on this 4 letters. Your mind should be working on the 4 letters. Okay, is it mandatory? Is it discretionary? Is it supposed to be, redeemable or irredeemable? And if the mode of payment is shares, what should come to the mind is fixed or variable. Your stress when you look at a question is you need to watch out on a very careful level that if I say cash, your mind starts working mandatory, discretionary, or you start looking at that is it redeemable, is it irredeemable? And you've got these words for the interest and dividend, and you've got these words for the principal repayment. And these words will decide is it financial liability or equity. And if you're looking at the shares, fixed variable will be the deciding factor. I hope, friends, you got my version number 2 very clear. So you got my version number 2 very clear in this case, that when I say the mode of payment is cash, don't say financial liability. See, is it mandatory? See, is it discretionary? See, is it redeemable or is it irredeemable in nature? And then take a call. Let's give you a small question, friends, at this stage. It's early, but not that early as well. Let's take a risk. And I can give you some permutation combinations to decide. And then we can go to some case studies. So let's do one thing. Let's create some combinations. I am considering the mode of payment is cash. And let me give you, two, three combinations only to decide. Let's see whether this sinks into the mind at this stage or not. Let's give you the data. I'm looking at the return. The mode of payment is completely cash. The mode of payment is completely cash. I'm looking at the return and I'm looking at the principal. Let's give you some combinations to decide. Number one, the return is mandatory and the principal is redeemable. Would you like to tell me what is the nature of the instrument? Decide, friends, decide. So I've given you the two elements. It is mandatory and it is redeemable. Apply the three-step model to each and every component on a separate basis and then take a call. So I get the answer, financial liability. I get another answer, financial liability. I am getting all the answers, financial liability. And that's wonderful indeed. I think everybody gave me the input that it is a financial liability. Absolutely correct. Because if I apply the concept, if it is mandatory, then this component is a financial liability. If it is redeemable, this component is a financial liability. And if both the components are financial liability, the instrument on an overall basis is a financial liability. Wow. Let's give you another one. What I am also planning to do is give you three charts. So why does everything surround around three? You've got three-step models. You've got three versions of the three-step model. Now you want to give us three charts also. Well, three is not a favorite number. It's just by chance that I've created those three. So three-step model with three versions and three charts coming in, you start getting a gripping in terms of Index 32. So what I'm planning is to give you three charts as well. The chart number one, when I consider the mode of payment is cash only and see some permutations and combination. Then we look at the chart number two, where the mode of payment is shares only, and look at the combinations. And then make a blended chart, which is, a mode of payment is shares and cash put together, and then see the combinations. I think that's going to make a life very simple. Because if I can visualize that, okay, if the mode of payment is cash, in these combinations, what is the answer? If it is shares, what is the answer? If it is a blend of shares and cash, what is the answer? You want me to make those three charts as well? I think yes, but I want to hear that yes from your side. So making those three charts, mode of payment cash only, mode of payment shares only, mode of payment both. But do you want me to give you these charts before doing the questions? Or after doing the questions? You got a choice to decide that. So you want me to give you the charts after we're done with some questions with you, or you want me to pre-hand give you those charts so that when you start looking at the question, you can connect it better? Let's get your inputs on that. So let me just come back on the agenda. I think I am getting yes. Yes means, of course, the chart would be given. So after, I think I'm getting the answer after doing some questions. Okay, then that's done. I think somebody is saying before, somebody is saying after. Let's give you another one as well. Now, let's say this is discretionary. Let's say this is discretionary. And let's say this is irredeemable. Now decide. So let's say this is discretionary and this is irredeemable in nature. Now take a call. What do you say? And I think I've started getting answers on that as well. I'm pretty confident we're going to get some good, correct answers. I get the answer. It is equity plus equity. That makes it equity. Wonderful indeed. So I think all the answers I'm getting is equity instrument indeed. Superb. So in this particular case, when it is discretionary, it becomes equity. When it is irredeemable, it becomes equity. If both the elements are equity, it becomes an equity instrument in nature. Super. So let's call this as a test. You passed the test very well indeed. So just connecting the dots before we go to another question. I'll give you a version number one, but that's now, overridden by this version number 2. So I think let's concentrate on the version number 2. Now, what you need to keep in mind is the first step is a contractual obligation. The second step is the mode of payment being cash, mandatory, discretionary, redeemable, irredeemable. And if the mode of payment is shares, fixed or variable, that decides the nature. And what is the most important input is you are going to run the three-step model on a component wise. Apply the three-step model to the return separately. Apply the three-step model to the principal separately. If both FL, both equity, one FL, one equity, CFI. Let's give you a small test now. Let's go to the study material. Let's have a look at the question to be given to you. So we'll do some basic questions also because we like to come back to some basic inputs also, but later. At the moment, I want to first go to the unit number 3. I'm actually wanting to go to the unit number 3. I think I did a question with you on the unit number 3 that was done, right? Okay, let's I think come back to another small little question. Yes, so here we've got a question. Let me just crop this up so that you can see it visibly better. This is again unit number 3, and in the unit number 3, it is illustration number 1. In the unit number 3, we've got an illustration number 1. I hope that's visibly clear, friends, to you. So let's, I think, read the illustration 1, unit number 3. So let me just read. I am just thinking, let me take a risk. Let's see, how many of you have understood it so well? Let's do one thing. Let's not read the question. Let's read the heading of the question and decide. Wow, what a feeling. I look at the word redeemable. I look at the word mandatory dividends. We like to make some call looking at only these two terms and decide. Don't even read the question. Just read the data. It is redeemable and it's a mandatory dividends. Would you like to decide what is the nature of the instrument? Ah, lovely indeed. I think I've started getting answers on that it is a financial liability. Wonderful indeed. I think everybody has given me the correct answers on that. Wonderful. Love you all. I think brilliant. You're all going absolutely great. But let's read the question. We can't be Rajnikant fans like that and we start reading and saying, oh, it's financial liability. Let's, I think, read. It says A is the issuer who issues a preference shares to B, who is the holder. It says the preference shares are redeemable. They are redeemable. It says at the end of 10 years from the date of issue. And it entitles the holder to a cumulator. When it says cumulative, which means due to any reasons whatsoever, if you're unable to pay a dividends on this date, it is going to be paid at a later date. Cumulative means it's going to be carried forward and paid later. So indirectly, you've got an unavoidable obligation to pay dividends, and it is redeemable in principle. Then he says the rate of dividend is commensurate with the credit risk profile of the issuer. Examine the nature of the instrument. So when it says it is redeemable, it's a financial liability. When you say it is a cumulative dividend, it is a financial liability. If both the components are financial liability, the instrument on an overall basis undoubtedly becomes a financial liability. We'll just still read the answer. It says the instrument provides for a mandatory fixed dividend payments, and it provides for redemption by the issuer for a fixed amount at a future date, since there is a contractual obligation to deliver cash, both for the dividends and the repayment. It cannot be avoided. It says very clearly, which cannot be avoided. The instrument is a financial liability in its entirety. So I think even if you go back and apply the three-step model, you can land up applying the three-step model in two different elements. You can say step number 1 is there is a contractual obligation, 1. The step number 2 is the mode of payment is cash. And when you look at the mode of payment as cash, you start looking at the dividend is in terms of mandatory, FL, the principal is redeemable, it's FL, and you can apply for both the components and get the results. Wow. So this is one question taken care. We've got more questions, we've got more charts to prepare, but I think we should first give you some time to relax your minds. What do you say? I know you must be feeling interested, you must be feeling this to go on, but I think let's get relaxation of mind. We'll do some more questions after this, then we'll make those three charts after this, and then we're going to start working on our three-step model on this. The version number three, which I need to introduce you today itself. Yes, I think somebody's got a question. Yes, Abrakesh, yes, please go ahead.
Good morning, sir. Sir, what about the last line where dividend is a function of credit risk profile?
Oh, I intentionally didn't explain that. No worry. So, in fact, even in the previous question, it was given that the dividend is commensurate to the risk profile. Now, this has got a very deeper meaning, and there is a very interesting illustration which is given in the study, as well as also in the appendix to the Index 32, which talks about irredeemable debentures being called as a financial liability because of this sentence. You're going to get this after the break.
Okay, thank you, sir.
You most welcome. Right, friends. So I think it's time to give you some break at this stage. I think 10, 12 minutes to the max, and then I will be back. So we'll start a journey after that. Please enjoy and relax in your breaks. Haji, thank you. I hope you are in relaxation of mind. So, a few more questions, I think, before we make those three charts as I promised you before the break. Let's have a few more look at some more questions. So, we're still on the unit number three, doing some questions on that. I'll just, I think, extend this. So, let's look at the illustration number two, three, and four. I hope you can see them clearly. Visible, right? Because I'm containing all these illustrations in one go. So maybe the font is a little small, manageable. You can see them, I guess. Having such a wonderful teacher, so we are blessed. Thank you so much indeed. I feel truly blessed on that as well. Okay, that's great. Let's, I think, begin. So I think let's try another input as well. Just look at the name and decide something. Let's not read the question. It says redeemable debenture, discretionary dividends. Let's see if you can decide with the help of this. So what do you say that we've got redeemable debentures and there is a discretionary dividends? So any wild guess on that? That's brilliant indeed. I think I got the input that it is supposed to be a compound financial instruments, and that's absolutely correct. Okay, I'm getting a message, not able to read much. Okay, I'll have to maybe hide the question in that case. Okay, then I think I'll have to cut that across. Let me just do one thing. Let me just slightly change this to you. Let me just crop this a bit as more. Oh my God, this is cut it into pieces. So I think you just have to manage this bit, I think, this part. So you rightly said it is a compound financial instruments because when you say it is redeemable in nature, so when you say it is redeemable in nature, it means a financial liability. When you say discretionary dividend, it becomes an equity instrument. So one component becomes FL, other becomes equity, undoubtedly CFI. But let's still read. It says X issues debentures to Y, and the debentures are redeemable at the end of 10 years from the date of issue. The interest is payable at the discretion of the issuer. So I think that's very clear that the principal is redeemable FL and the dividend is discretionary equity. And what is the nature of the instrument? Though you can see the same sentence, what I think my friend asked me, and I said, I'll explain that bit a little later. But I think, don't worry, we'll come to that sentence later. Let's, I think, just have a quick look. The instrument has got two components. As I said, you should apply your inputs on the two components separately. There is a mandatory redemption, which is for a fixed amount at a fixed future date, and the interest is at the discretion. The first component is a contractual obligation to deliver cash that cannot be avoided, so therefore it becomes a financial liability. The second component is the interest, which is at the discretion, hence would be classified as equity. And then it says this is again discussed in compound financial instruments, but I think I've already given you that this becomes a CFI. Great. Let's go to the next one. Now, this is interesting. It says there is a perpetual loan. Perpetual means irredeemable in nature, and there is a mandatory interest. Would you like to decide on the basis of the heading itself? It says there is a perpetual irredeemable loan and there is a mandatory interest. So would you like to decide what is the nature of the instrument with the heading itself? And yes, that's right. I'm getting the input. It is a CFI, correct. So let's, I can read this further, but we'll revisit this illustration very shortly later. I'll revisit this illustration later again. So I'm right now saying it is a CFI, but I'll revisit this illustration later. It says P company takes a loan and the loan is perpetual irredeemable and entitles the holder to a fixed rate of 8%. What is the nature? It says it has got two components. There is a mandatory interest for a fixed amount at a fixed date, and there is a perpetual nature of the principal. It says the first component is a contractual obligation and that cannot be avoided. So he only gives you the answer on the first component, that it is a financial liability, because in the study material before these, as these illustrations are given, the discussion on CFI was not done. But I have just taken a liberty of doing some discussions on a CFI in advance. Okay. Now, this illustration 4 is not exactly a question, but it's more like a clarification. And I think, give you that clarification by the way. The standard very clearly brings out one very important aspect, that I have a contractual obligation, it's a financial liability. My inability to pay cannot mean that there is no financial liability. Let's get this straight. You cannot negate the fact that there is no financial liability on the ground that I'm unable to pay. So I have a contractual obligation to pay. It's a financial liability. My inability to pay is not going to be factored to decide it is equity or FL. That's what illustration 4 is about. It says, does the lack of access to foreign currency or the need to obtain approval for payment lead to a contractual obligation? It says the lack of access to foreign currency or the need to obtain an approval, it says for the payment, does not negate the entity's contractual obligation or the holder's contractual right under the instrument. So in any case, your inability to pay, let's say, for example, you're under some restrictions to make payments, your inability to pay does not negate the fact that it's not a financial liability. Okay, that's simple and straight. Okay, so I guess we'll leave that illustration 5 at the moment, not at this stage. Now we're ready, friends, to do some charts with you. So let me make some interesting charts to you at this stage. We will jointly make these charts. So we're going to make 3 charts summarizing the position of what we've learned so far before we go to the version number 3. So let's make the chart number 1. Now, if you're able to answer majority of these questions in the chart, then I think your fundas are going super. So I am taking the mode of payment as cash only. I'm taking the mode of payment as cash only. So the chart number 1, where the mode of payment is cash only. So I'm going to give you the permutation combinations. Please apply the logics what we've learned and decide, is it equity, is it FL, or is it CFI? Let's begin the journey. So I'm going to give you the inputs on the return, the inputs on the principal, and decide. So we're looking at the return, we're looking at the principal repayment, and we will decide the nature of the instrument. The mode of payment is cash only. So I'm going to give you some permutation combinations and you decide if this. Okay. Let's say I give you the combination 1, it's mandatory. And let's say it is redeemable. Decide. It is mandatory and it is redeemable in nature. So when you say it is mandatory and it is redeemable in nature, apply the 3-step model and take a call. Okay, so I think I'm started getting some answers on that, and I'm just going to pick up a few answers on this, and that's right, it is a financial liability. This is FL, this is FL, so overall the instrument becomes FL in nature. Great. Let's say this is mandatory, and let's say this is irredeemable in nature. It's a slight little change. Let's say this is mandatory, the status remains the same, but this is irredeemable in nature. Now decide what would be the status. And I think we start getting answers on that, and that is right. It becomes a compound financial instrument because this is FL and this is equity. So rightly said, this is going to become a CFI. Good. Now I think you can guess, how I'm going to proceed in my combination. Now let's say this is discretionary Let's say this is discretionary, and let's say this is redeemable in nature. Now decide. So this is discretionary return, and there is going to be mandatory, it's redeemable in nature. And I think that's also very rightly given. This becomes equity, this becomes FL, so both the elements put together becomes a CFI. Good. Let's go to the next combination. And trust me, you would be already thinking of that combination already. Now, let's say this is discretionary and this is, let's say, irredeemable in nature. Now, decide what would be the combination. Discretionary return and irredeemable. That's right, equity, equity. That makes it a total of equity instrument in nature. Wow. I think the chart number one seems to be clear to everybody. And you must be feeling wonderfully confident on this as well, that yes, we are getting the inputs. Lovely indeed. I think I'm getting some good answers from everybody. I have to sometimes go back to and scroll your answers indeed, because I think I'm not able to send the messages to everyone. So but I think I'm just still checking the answers. It's perfectly correct. Wow, wonderful indeed. So my chart number one is done. Let's make another chart now. Let's make another chart. So we're going to make a chart number two, which is pretty simple and straight indeed. There's nothing more complicated. In the chart number two, I'm going to consider the mode of payment as shares only. So let's keep this chart as the mode of payment as shares only. So this is my chart number two, where I'm considering the mode of payment is shares only. And I believe there are going to be only two combinations in this case. There are going to be only two combinations in this case. You can also do a wonderful exercise later when you revise. Pick up the questions we have done and keep filtering them in terms of, which chart the question fits in. Get some very good mind maps made for your last minute revisions before the exams. So I think this is simple. So we can say there are only two combinations, that you'll end up giving a fixed shares or you'll end up giving a variable number of shares. Now, would you like to take a call and tell me? So now we are looking at that it is fixed and variable in nature. I think we can easily decide that if it is fixed, it is equity instrument, and if it is variable, it is a financial liability. This is the combination decided earlier as well. So chart number two is not very technical indeed. Okay. Now comes the interesting chart number three. Now comes the interesting chart number three to you. So in this chart, I'm going to take both the combinations. So let's consider the mode of payment as cash and shares both. So let's consider the mode of payment as cash as well as the shares both. And what I'm going to do in this case, I'll take the return in cash, the dividends and the interest, and I'll take the principal in terms of shares and give you some permutation combinations in this case. Okay, let's work on this. So let's make a permutation combinations to you on the return element, on the principal element, and we'll decide the nature in this case. So let's take the return, which is in cash. Let's take the principal, which is in shares, and we decide the nature of the instrument as well. So let's start giving you the permutation combinations, and you can start deciding again on this agenda. Let's say this is mandatory, and let's say we are going to give variable number of shares. It's mandatory, and we're going to give variable number of shares. Decide. This is a mandatory dividends, and there is going to be a variable number of shares which will be issued. And I think I'm starting getting good answers that this becomes, you said CFI, is it? Or was that a previous answer? Okay, we get FL, that's right. And this is again FL, that's absolutely correct. And number of share fixed, okay, that was for another previous one. That is correct. Yes, it is undoubtedly financial liability in nature. This is FL, this is FL. So overall, it becomes a financial liability. Let's make the combination further. Let's say this is mandatory and let's say this is fixed. I think you'll outrightly decide. I've just changed the variable to a fixed number in this case. Superb. And that becomes a compound financial instrument in nature. That's right, absolutely. Because this becomes FL and this becomes equity in nature. Okay, now let's change the combination discretionary. Let's say this is discretionary and let's say this is variable in number. Now decide what would be the nature. Discretionary, it becomes equity, great, and that is variable liability, wonderful. It becomes a compound financial instrument. Lovely. I am getting confidence that you've got the concepts fully. And then we can take a discretionary and take it as fixed in nature, and you can decide what would this be. This is supposed to be discretionary and it is fixed in number. That's right. Both the elements are equity. The instrument becomes equity instrument in nature. Wow. So I think my version number 2 is 100% done as well. Version 1 now takes a back seat. Now the only learning which you've got in mind is these 3 charts based on the version number 2. My version number 2 gives me the combinations of these 3 charts. And just to reiterate again, there are mainly 2 things we've learned so far. If somebody tells me, sir, tell me the crux of the learnings today, I'll tell him there are 2 main inputs. Run the 3-step model for the return and the principal separately. That's one learning. The second is when I say mode of payment is cash, your mind starts working mandatory, discretionary, redeemable, irredeemable. And when I say that it is mode of payment shares, fixed and variable, that decides the agenda. Wow, so this is done. Now let's do a little more warm-up exercises before we introduce you to the third version, because that's going to be a bit technical in nature. We're going to start working on the version number 3 as well. And before that, I think let's do some warm-up exercise further. So I'm now going to take you to a few illustrations which are there in terms of Unit 1. So we will go to the illustrations which are there in terms of Unit 1 just to, assess the inputs. Okay, let me share this to you and we'll discuss this part as well. I hope that becomes visible. So otherwise, I'll cut down the lower portion. Let me know, friends, if this is clearly visible. I need the third illustration also after that. Is that visible? Very easy now. Thank you very much indeed. So please let me know if this is clearly visible to you. Then I can proceed further. Yes, that's great indeed. So let's, I think, proceed further. Now, let's have a look at the concept of financial liability, basic, simple exercise. So we just need to make an assessment that is there a contractual obligation to pay cash or shares, fixed or variable. That's it. Basic application of the 3-step model. Let's begin. It says there is a loan payable or a bank loan. Undoubtedly, there will be a contractual obligation, one, and unless mentioned otherwise, the mode of payment is cash. Can I undoubtedly say that there will be a mandatory obligation to pay the interest and there will be a mandatory obligation in terms of making the payment of the principal? Yes. So it is undoubtedly a financial liability. Even if you say trades and other payable, the same logic works. Even if you say bills payable, the same logic works. So you've got loans payable, you've got trades payable, you've got bills payable. They're all financial liability in nature. Then it says there is a deposit received and you've got an obligation to pay cash. Same logic works. Mandatorily redeemable preference shares. Now, when I say mandatorily redeemable preference shares, I assume that the dividends are mandatory, the principal is mandatory, and that makes it a financial liability with the same logic. So you can see basically you're looking at examples of what are financial liabilities. And then it says there is a financial guarantee which is given. So financial guarantee given would also lead to a contractual obligation that is also a financial liability. The idea of doing this particular case is just to recreate, a few examples of financial liability apart from those preference shares and all. So if you say there is a creditor, a trades payable, yes, a loans payable, yes, a deposit received, yes, all these are examples of financial liability. Now, I think before we go further, let's talk a bit on the financial assets as well, because I think we just need to get some dots connected on the financial assets as well before we come back to this illustration. So what I'm doing, I'm now going to go back on the financial assets video. Let me crop this out, and I'm just going to now work a little on the financial assets video. Though we have not discussed the concept of financial assets, but with these example, I want to give you a basic flair on the concept of financial assets. Okay, now before we look at this example, I think let me first make one thing very clear. I would say there are two kinds of assets. One is financial and one is non-financial. Don't worry, I'll document that as well. So I would say that there are two kinds of asset. One is called a financial asset and one is called a non-financial asset. Now, when I say it is a financial asset, just like a financial liability, there is a contractual obligation to pay. For a financial asset, there is a contractual right to receive. But there are certain assets which do not give you a contractual right to receive, but they give you an opportunity to receive. So those assets which will give you an opportunity to receive are going to be considered as non-financial in nature. And let me also tell you one thing more. If your contractual right to receive is in terms of goods and service, it's not a financial asset. Just like in terms of financial liability, the mode of payment is cash or shares, the contractual right to receive should also be in terms of shares and cash. If your mode of receipt, your contractual right to receive is in the form of goods and services, it is not going to be a financial asset. So what I want to make a little point at this stage is just to add a small little inputs at this stage. Because we've been talking only on liabilities and equity instruments, let's talk a bit on the financial assets as well. So when you're looking at the concept of financial assets, your mind should get tuned that there are two kinds of assets, non-financial, which gives you an opportunity to receive, and financial, which gives you a contractual right to receive cash or shares, but not anything other than cash and shares. If it is goods and service, it becomes non-financial in nature. Let me pin this down. So I would say, if I would understand the assets are of two types, we can say one is what you can say non-financial in nature. One of the assets is what is called non-financial, and the other one is what is called financial. So we can say we've got two assets, non-financial and financial in nature. When I say it is non-financial, they create an opportunity. I would say they create an opportunity. They create an opportunity to receive benefits. They create an opportunity to receive the benefits that is called non-financial in nature. When you say that they're financial assets in nature, they create, you can say, a contractual right. They create a contractual right to receive. They create a contractual right to receive. And the contractual right to receive should be in the form of cash, or it could be in the form of shares. But in this case, let me already tell you that if you are going to get the right to receive in terms of goods and service, If the contractual right is to receive goods and services, then it is not a financial asset. So let me take a small little test at this stage. Before we go back to the example, let me just give you a small little test and you can decide that is it a financial or is it a non-financial asset with a very basic common sense. That if it's going to create an opportunity to receive benefits, it's non-financial. And if it is a right to receive cash or shares, it is financial, but goods and services, no. Let's put some quick questions to you. You know, let's say, for example, if you go back to those asset related standards which you've studied, PPE, intangible assets, investment property, what do you think? They're financial? Or do you think they're non financial? Do they create a right to receive or do they create an opportunity to receive? And that's why we said it becomes non-financial in nature because PPE is going to use to produce goods and service, and that creates an opportunity to receive benefits, non-financial. Let's say, for example, I have given an advance to my supplier. If I've given an advance to the supplier, it's an asset for me. So am I going to call this as financial or non-financial? I gave an advance to the supplier who is going to give me goods and services in return for the money, not cash, not shares. And that also becomes non-financial in nature. But let's say, for example, if you tell me cash, financial asset defined in the standard very clearly says, number two things which you need to keep in mind. Investments are always financial assets. If you look at the definition which is given in the standard on a financial asset, cash is always a financial asset, point blank. Investments, even if you invest in equity shares, it is always a financial asset. The definition itself is very clearly said that investment in the equity shares of another company is a financial asset. So you say cash, it's financial asset. You say investment in equity shares, it's a financial asset. But if you give an advance to the supplier, non-financial. All those assets, tangible, intangible, PPE, intangible, investment property, they're all supposed to be non-financial in nature. I think let's now come back and just come back on this example. The answers are given, but we're just going to look at the inputs and decide, is it financial or not? We just, deviated a bit from the concept of financial liability equity, a little on the holder, just to get a little more connect that, we also have some idea on the financial assets as well. Let's come back. So it says investment in bonds and debenture. Yes, it undoubtedly gives you a contractual right to receive cash. It's a financial asset. There are loans and receivable. The same logic works. It's a financial asset. The deposits which are given, the same logic works. There are trades and other receivable, it's financial asset. And look at cash and cash equivalents. It is specifically covered in the definition itself. If you say cash, cash is the medium of settlement. And cash is always considered to be a financial asset. So if somebody says what is a cash and a cash equivalence, 100% always a financial assets in the balance sheet. The bank balance gives you a right to receive. That's again a financial asset. So these are all examples of financial assets in nature. Then he says investment in equity share. This is also specifically defined in the definition. This is also specifically given in the definition that investment in equity shares is supposed to be covered under the purview of financial assets. But let me tell you one thing, friends, which I will remind you later again. Though I should not be saying complicated things in the very first class, but I think I want to, just put that into your mind. So that, some way or the other, it remains in the mind because we'll work upon that once we come to Index 109. A company makes an investment in a related party. A company makes investment in equity shares of related party, subsidiary, associate, joint venture. Index 109, Index 32 not applicable. It is a financial asset but it is outside the purview of these financial instrument standards. If a company makes investment in the equity shares of related companies, subsidiary, associate, JV, financial instrument standard does not apply. It is a financial asset, but the financial instrument standard does not apply. But if you're making investment in the equity shares of unrelated companies, only then financial instrument standard would apply. So when it says investment in equity shares, per se, it is definitely a financial asset. But one thing which I want to make it very clear, that if you invest in related party equity shares, financial instrument standard does not apply. But if it is unrelated, it applies. So let me put this down here itself. Then if you say that you've got investments in equity shares of related parties, it is a financial asset, but we can say the standard on financial instruments is not applicable. But if you say that the investment is in terms of unrelated parties, then in that particular case, the standard on financial instrument is definitely applicable. It is definitely a financial instrument. So please remember this very clear, because we will work upon this later, that if you've got investment in equity shares, it is a financial asset. It's given in the definition. But if it is a related party, in that particular case, the standard is not applicable, unrelated is. Let's go further. Then he says perpetual debt instruments. I think if you make investments even in irredeemable debt instruments, it is a financial asset. What about the physical assets like inventory, PPE, tangible assets? They're non-financial because they create an opportunity to, give you benefits. Even if they're leased assets, right to use assets, what is called ROU, that is also considered to be a non-financial asset because they create an opportunity, not a right to receive. Then if there are intangible assets, that also is non-financial. So whether it is tangible, whether it is intangible, or even if it is leased assets, they're all non-financial in nature. If there is a prepaid expense, the answer is no. Why? Because if you're prepaid, let's say something, you are going to get in return services. You're going to get goods and services. So any expense which is paid in advance, any supplier advance, you will get goods and services in return. So they will never be financial asset, because the mode of payment in this case, is goods and services. Advance which is given for goods and services, again a no, because here again you can say goods and services is the mode of payment. Wow. So we're just connecting a few dots now. I think now I know very clearly a good examples of financial assets, a good examples of financial liability. Though we've been talking only from the issuer point of view, but I think it was a little more important to understand what are the examples of financial assets. So we can say that if you've got any tangible, intangible, or leased assets, non-financial. If you've got any kind of prepaid expenses and advances, non-financial, because you are going to get in return goods and services and not cash. The typical examples of financial assets would be cash in bank, rather I would say cash and cash equivalents. It could be investments in debentures or bonds. It could be investment in equity shares of the company. All investments will be taken. Any loans and advances which are recoverable in cash, yes. And that gives us a basic idea on that input as well. Okay, so far so good. I think we've got the dots connected. Now we're ready to go to the version number 3. Now, friends, before I go to the version number 3, I have a small little inputs to be asked you. Do you know about derivatives? Or do I need to expose you on the concept of derivatives? If you want, I'll start explaining you about derivative, because my version number 3 will require the understanding of derivatives. So give me your inputs. Are you aware on the concept of derivative, or do I need to explain you the concept of derivative? I get the answer, yes, we are aware. And I am looking more answers as well. Not yet, sir. And I am in AFM derivative changes we have started. Okay. And I think I'm getting the messages. So please explain. So I think some of you are not much aware. I think I'm getting a couple of messages. So please explain that part as well. Okay. No worries. I think I'll explain you. Some people are giving me some examples as well. Okay. So let's do one thing. I will assume that you do not know about derivatives. For those who know, it's wonderful. For those who do not know it, it's okay. Let me explain. But before I come to the concept of derivatives, there is something which is pending, but I will not be discussing at this stage. Let me just remind you, there was a question which I said, I need to come back, but I said I'll be coming to that later. Now, this is the one. The illustration number 3, this is the one which I need to come back to you. So I will be coming back to this illustration 3, the perpetual, because one of the questions is pending from my friends. Rakesh asked me, so what do you mean by that the credit risk profile is commensurate to the risk of the issuer? I will be answering that once I answer the illustration 3. So let's keep it pending for some time. Let's, I think, now go back. So I am now taking you further. So right now I'm going to give you inputs on derivatives. So we'll just discuss derivatives at the moment. Then we'll add on the learnings in terms of the step number 3 to you. So please hear me carefully. For those who are learning derivatives for the first time, I'm going to teach you from the scratch and only teach you to the extent I need, because accounting for derivatives is also a part of the Ind AS 109. In Ind AS 109, we're also given the accounting for derivatives, so we'll cover that as well. So let's give you the inputs on derivative. We're out of the 3-step model at the moment, and we're talking in terms of derivatives. Let's say, for example, I am telling somebody for the first time in life what is a derivative. I always take a very basic example to explain this. Now, let's take a very simple example. Let's say I buy a PVR ticket. Let's say the PVR ticket is available, let's say for 300 rupee. I'm just taking an assumption. Don't judge me that he doesn't know what is the price of the ticket is. It's fine. I'm just taking an example to illustrate that let's say the price of the ticket is 300. What does this mean? That you can pay this 300 rupees and buy the ticket and take a physical delivery. As simple as that. Let's say somebody gives me a PVR pass, and it is written on the pass that it is transferable, though it is generally never. But let's say it is written on the PVR pass that it is supposed to be transferable. I can transfer that PVR pass to anybody and sell it. Now, I have a very simple question. Let's say the movie is a big hit and the tickets are not available. Mind the words. Let's say the movie is a big hit and the tickets are not available. Can you tell me what is the minimum price at which I will be able to sell this PVR price? Let's see your common sense. The movie is a big hit and the tickets are not available. So what is the minimum price at which you will sell this PVR price? I'm talking about the minimum price. And I think I am getting the inputs. And I'm given that it's going to be sold at 300 rupees. That's absolutely correct. I think most of you said that it's going to be 300. That's absolutely correct. So the minimum price at which you're going to sell this PVR pass is 300. And you can say, how did you get this 300 from here? The word derivative comes from the English dictionary word called derives. When you use the word derivative, it basically derives its meaning from the word derives. So can I say the pass is deriving its value from the PVR ticket? The pass is deriving its value from the PVR ticket. So in this case, we can say it can be called as a derivative. In technical words, we say that if a particular contract or if a particular instrument derives its value from an underlying asset. Mind the words. So we say that if a contract or if a particular instrument derives its value from an underlying asset, it is called derivative. It doesn't take its own value, it derives its value from another underlying asset. So in this case, I can say this derives its value from the underlying asset, and we can say it fulfills one of the characteristics of a derivative. If you meet this characteristic, you cannot say it is a derivative. Just meeting this characteristic does not mean it's a derivative. The standard in Indus 109 has given us three characteristics, or you can say three parameters of calling it as a derivative. And you need to meet all the three parameters to call it as a derivative. Even if one of the parameter fails, it's not a derivative. You need to meet all the three parameters, then it is a derivative. So we can say that as far as derivatives are concerned, there are going to be a total of three parameters. So we'll see what are those three parameters, and you need to meet all those three parameters to call it as a derivative. So we need to see what are those three parameters. But before that, let me tell you, the most common kind of derivatives are what is called forward, futures, options, and swaps. If somebody would tell me that, okay, give me a comprehensive list of all the kind of derivatives, I would say typically four. You can enter into forward contracts, you can enter into futures contract, you can enter into option contract, or you can say that you enter into swaps. And these are the most common kind of derivatives. So I think let's do one thing. Let's first of all understand what are the three parameters of a derivative. What are the three parameters of calling it as a derivative? Then we'll also see the different kinds of derivatives as well. So we can say there are three parameters of calling it as a derivative. So we can say the first one is the value. The value of a derivative. The value of a derivative is derived. The value of a derivative is derived from the value of an underlying asset. So this is one of the characteristics or the parameters, you can say, of calling it as a derivative. So the value of a derivative is derived. It says from the value of an underlying asset. If you can prove it, that the given instrument, the given contract derives its value from the value of an underlying asset, the feature number one is met. The second feature, the contract will be settled in the future. The contract will be settled in the future. The contract will be settled in the future. So that is another important input, that the contract is going to be settled at a future date. You're not going to settle the contract today. If you want to call an instrument contract as a derivative, you need to prove it to me that you're going to settle the contract at a future date. That is another characteristic. And the third characteristic is that there is negligible. There is negligible, or we can say no investment. There is negligible or no investment at time zero when you enter into the contract. When you enter into the contract, there is no investment, or maybe if there is an investment, it is a negligible amount of investment. So you need to prove it to me that there is a negligible or no investment at time zero. If you're able to fulfill all these three characteristics, as I said, you need to prove 1 plus 2 plus 3, then only it is going to be called as a derivative. So every time you face a particular contract, you need to put three questions. Number one, you will say, okay, is the settlement going to occur in the future? Yes. There is no investment today? Yes. The value depends upon the underlying asset value. Yes, it's a derivative. It's a derivative in this case. I hope you got the basic connect clear that what are the three parameters. We'll see the different kinds of derivatives as well. So we can say, if you now tell me what are the common types, if you ask me what are the common types of derivative, I would say the common types are, one is called forward, one is called futures, one is called options, and the other one is called swaps. So these are the common types, that is called forwards, futures, as well as options and swap. So these are the three characteristics and the common kind of, you can say, derivative contracts. Okay, so let's do one thing. Let's, I think, understand, for example, a forward contract. I'll not get into each and every category of derivative, but I think let's understand a very simple example of what is a forward contract for the time being. So I think let's take it further. So in this particular case, let's explain you what is a forward contract. Now, when I'm taking the example of a forward contract, I will consider, let's say, currency as a base. As you're going to study more in detail in AFM, you're going to see that when a company enters into a derivatives, they can enter into different varieties of derivatives. You can enter into, you can say, stock derivatives, shares. You can enter into, you can say, currency derivatives. You can enter into what is called commodity derivatives. So the company can enter into a derivative contract in terms of currencies, in terms of stocks, in terms of commodities. Well, I'll not get into that detail, but since the idea is to just tell you what a derivative is, I'll take first of all an example of a forward contract which is relating to currency. So for example, let's take an example. Let's say there is a company which is supposed to be an importer. And this company, let's say, wants to buy a machine. Let's say this company wants to buy a machine, let's say to the extent of $1,000, but this is going to be bought 6 months later. So let's say there is a company which wants to buy a machine for $1,000 6 months later. He is in India and his function currency is Indian rupee, but he wants to buy a machine, let's say for $1,000 6 months later. Now, what is his concern? His concern is that the exchange rate may increase and he will end up paying more Indian rupees to buy the machine. Let's say the exchange rate today is, let's say, 70. He apprehends that the exchange rate might become 80, so he'll shell out more rupees to buy the same number of dollars. So he's very apprehensive of the increasing exchange rate. So what he can do, he can go to the banker today. He can go to the banker today and he can go to the banker and say that I want to enter into a contract with you today. He says, I am going to enter into a contract with you today wherein I will buy the dollars 6 months later. So what he does, he enters the contract today. He enters the contract today itself with the bank and tells them that he will buy 6 months later. He'll buy 6 months later, but the contract is entered today. The bank says, okay, we'll enter the contract with you today that you can buy these $1,000 6 months later, but we'll give you the rate of exchange today itself. So the bank tells him the rate at which you can buy these dollars today, but things will happen. The things will be executed 6 months later. Now, let me ask you a few quick questions at this stage. In this particular case, is there any investment I would make at 0 point of time? No. When I am going to enter a contract with the bank, I am not going to make any payments to the bank. It's just entering into a contract without making any payments at the time zero. So is there any initial investment in this case? No. Is the settlement going to be done at a future date? Of course, yes. You've entered into the contract today, but you're going to settle the contract 6 months later. And tell me, is the rate of the forward contract, is it getting derived from the rate of exchange prevailing in the market? Is the rate under the forward contract getting influenced by the rate of exchange which is prevailing in the market on the currency factor? Of course, yes. So, which means the value of this contract derives its value from the exchange rates prevailing. There is no initial investment, and the settlement will be done at a future date. So, we will undoubtedly lead to a conclusion that this particular contract is called a forward contract. This particular contract is called a forward contract, and it is undoubtedly a derivative in nature. It is undoubtedly a derivative because all the three characteristics are met. And you know what? If you see that there is a forward contract given in the question, invariably I will presume, unless there is anything to the contrary, mind the words. If I read a question and it says that the company is entered into a forward contract, unless there is any facts to the contrary, I've got reasons to believe that it is a derivative contract. But still, I would say that you must evaluate that all the three characteristics needs to be met. Don't come to the conclusion immediately that it is a derivative by the name. No, no, no. Never go by the name. You don't need to go with the name of the instrument. You need to decide in this particular case that, okay, is the value getting derived from the underlying asset? There is no initial investments, and the settlement is a future date. Because sometimes, let's say, for example, I give you a contract and I say that you need to pay the entire money today. The settlement is going to be done at a future date, but I tell the person you need to pay the entire money today. It will fail the criteria of a zero or a negligible investment. And in spite of the fact that it might be a forward contract, it's not going to be called as a derivative. I hope I'm very clear on my thoughts. So this is an example of what we call a forward contract. And just wanted to show you that, the three features are getting fulfilled by looking at this particular contract. Let's take another example as well. Let's take another example and give you another derivative as well, options. I'm not giving you futures because futures are quite similar in terms of forwards, with some differences, of course. But let's give you an example in terms of options. Now, let's take an example to understand. Mr. A goes to Mr. B. Mr. A goes to Mr. B and tells him that I want to buy, let's say, 1,000 shares. I want to buy 1,000 shares of company XYZ Limited from you at the rate of, let's say, 120 per share. So Mr. A goes to Mr. B and tells him that I want to buy 1,000 shares of company XYZ at the rate of 120 per share. But he says, I don't want to buy it right now. He says, I will buy these shares, let's say, 3 months later. He says, I will buy these shares at 3 months later. So when A tells B that I want to buy the shares from you, but 3 months later, the contract is entered today. But the shares will be bought at 3 months later. Now, generally, what happens in terms of an option contract is that Mr. A in this particular case is going to pay a premium. He is going to pay a premium. He is going to pay a premium to Mr. B. And he will pay this premium so that Mr. B cannot refuse him. Mr. A in this particular case is going to pay a premium to Mr. B. And in this particular case, the premium which is paid will give Mr. A a right that Mr. B can refuse. Because in terms of options, you are telling the other person that if I want to buy, I'll buy. If I don't want to buy, I'll not buy. Just like ESOPs. In terms of ESOP, the employee gets an option to buy the shares of the company. He may or may not buy. So even in this particular case, when you say it's an option contract, Mr. A pays a premium to B, and tells him that after 3 months, if I feel, I'll buy. If I don't feel, I'll not buy. In terms of a forward contract, if you're paid, if you've entered into the contract, you need to honor the contract. You cannot walk out of a forward contract. If you've entered into a forward contract, you need to honor the contract at the end of 6 months. But in terms of option contract, since you're going to pay a premium, which is going to be a very nominal amount, let's say you pay a premium, let's say 2 rupees per share. So since you're paying this premium, you get a right to tell Mr. B after 3 months, no, I'm not interested. And this is what you know is called a call option. I'll not get into call puts at this stage, but I just wanted to give you some basic input that Mr. A pays a premium to Mr. B and tells him that after 3 months, I will get the right to decide. If I want the shares, I'll buy. If I don't want to buy the shares, I will not buy. This premium is yours. You keep this money, but I get the right to decide after 3 months I want it or not. Now let's put those three questions to yourself. Now tell me one thing, is the value of this particular contract, because when he says I want to buy the shares at 120, is the value of this contract derived from the share price of XYZ? Of course, yes. The value of this particular contract is derived from the share price itself. Is there any investment which is made today? Yes, it is. But do you think that investment is substantial or is it negligible? I think if you look at the contract value, it's 120 per share. And making a premium of 2 rupees per share, I think the amount is negligible as compared to the contract value. So I would say, unlike a forward contract where there was no investment, in the option there is an investment, but negligible. And is this contract going to be settled at a future date? Yes. You are going to settle the contract at a future date itself. So are the three characteristics met? Is the value of this contract deriving its value from the equity shares of XYZ? Yes. Is there any initial investment? Yes, but negligible. Are you going to do a future settlement? Yes. So in this particular case, when you say it is options, it meets all the characteristics and it can be called as a derivative contract as well. So the idea was not to take you too much deep, but the idea was to get a basic understanding of what are derivatives in nature. So let me just connect the dots now. I'm not giving you the examples of what are swaps or what are futures. I'm just giving you a few examples, forward and options, just to get a very basic understanding of what a derivative. We'll maybe discuss calls and puts and all at a later stage in detail. But right now, I just wanted to make one thing very clear. A company may enter into a contract which is going to be settled at a future date. One, there is no or negligible investment today. Two, and the value of that instrument contract derives its value from another underlying asset. If these characteristics are met, it is called a derivative contract. And in this case, all the three characteristics need to be met. Any one characteristic fails, it's not a derivative in nature. Now you must be thinking, why am I taking you to the concept of derivatives at this stage? Now, please hear me carefully. All my discussions before derivative was relating to a non-derivative contracts. And I introduced the concept of derivative. How am I going to use the concept of derivatives in this entire journey on financial instruments? That, of course, we'll do a little more detailed discussions in the next class. But let me tell you one thoughts at this stage. When I look at my financial instruments from the issuer perspective, apart from saying that it's equity, liability, or CFI, another way of looking at is that it is supposed to be, you can say, non-derivative, derivative, or a mix of derivative and non-derivative. All these financial instruments can be non-derivative contracts. They can be derivative contracts, or they can be mixed. Wait for more inputs. Today, I've only given you some basic idea on what is a derivative. Next session, we're going to add on this concept and go to a version number 3. Wow. So I think now you must be feeling, a little more data is coming to your minds. So what do you need to do, friends? You know that very well. You need to make your revisions before the next class. What I'm also going to do, generally habit of doing that, when we're going to meet in the next class before I'll start early in the morning, we'll give you a quick recap of the learnings in a quick way. Just make some quick mind maps of the previous learnings. And that'll help us to consolidate our learnings each and every session as well. Wow, feeling a bit heavy, I guess. Maybe. If yes, good. If no, still good. Right, friends, any questions on your side? So I think that's all what we have in terms of the financial instruments today. The version number 2 gets completed. I am going to add this input and make my version 3 in the next class with you. Yes to all. Sir, you made it extremely easy to understand. You should teach FM also. So wonderful. Thank you very much indeed. But I'm happy teaching FR. Okay, we got some more messages coming. And thank you very much indeed. Thank you very much. So perfectly explained as a layman in an understandable way. We are blessed. Thank you very much indeed. I think I feel equally blessed on that. All clear. Thank you very much indeed. So that was wonderful interacting with all of you. Looking forward to the next journey, the next class with you, friends. Thank you. Bye bye. Enjoy the weekend, not the weekend. We're going to see you before the weekend on Saturday. So thank you. Bye bye and take care.
Thank you, students, and hope you are enjoying the session. This is technical topic, but sir will make it very easy and very friendly to you all, so you find it very interesting also. So students, what I request to you all is that be maintain that continuity and class attend all the classes. This will only help you to understand this technical topic. Okay, all the best everyone. Thank you, sir.
Thank you, ma'am. Thank you so much. Haji, thank you very much. Thank
Thank
you.
you, sir.